Welcome to The Explainer. Today, we're putting on our Warren Buffett hats and going deep, really deep, into the raw financial data of Fidelity National Information Services, or FIS. If you follow fintech, you know these guys process a massive chunk of the world's financial transactions. But look past the headlines, and the raw numbers, well, they're telling a deeply conflicting story. So let's rip apart the metrics, approach this like true, rigorous value investors, and see what's actually happening under the hood of the business itself.
Okay, let's dive right into this. Here's our roadmap. We'll start with the big performance mystery, compare the short versus long-term growth rates, and check out the debt and cash picture. Then we'll analyze their profitability trends before ending on the ultimate question: is this valuation actually justified?
Section 1. The FIS Performance Mystery. You know, whenever we assess a company's financial health, we always start by looking at the market's long-term verdict.
And wow, here's that verdict. Negative 67.77%. This is the 5-year total return for FIS. I mean, it is a massive, wealth-destroying drop for long-term shareholders. Over the last half-decade, while the broader markets have seen significant gains, FIS has just severely punished its investors. And honestly, this dramatic decline is exactly what sets up the central mystery for our explainer today.
Now, what's really interesting here is the incredible juxtaposition. On the left, you have that agonizing 5-year plunge of nearly 68%. But then, look to the right. The trailing 12-month net income compound annual growth rate is exploding by a staggering 232.50%. I mean, how on earth can a stock price plummet so aggressively over 5 years while its recent net income growth is absolutely surging like that? To solve this, we really need to dig into the actual growth rates. Section 2. Growth rates, short versus long. Let's investigate the top and bottom line growth to see if this recent surge is just a fluke or the beginning of a massive turnaround. So this table tells the story of a real operational shock to the system. Look at the top row. 5-year revenue is actually shrinking at a negative 2.06% rate. Fast forward to the 3-year average, it's up to almost 10%, and the trailing 12 months shows over 12% revenue growth. Now check out earnings per share on the bottom row. It was already a healthy 57% over 5 years, but the recent TTM EPS growth is, wait for it, an eye-watering 3,055%. But hey, let's put on our skeptical value investor glasses for a second. An EPS jump of 3,000%? That's rarely just radical optimization. That kind of number is usually the hallmark of a massive structural change, like an asset write-down or a major corporate spin-off, rather than just organically selling more services.
But before we get too excited, we have to look at the absolute lifeblood of any business, free cash flow, or what Buffett famously calls owner earnings. And guys, this is a massive red flag. Despite that explosive accounting earnings growth, free cash flow is persistently shrinking. Whether you look at the 5-year, the 3-year, or the trailing 12 months, it's contracting by double digits, currently sitting at negative 13.18%. Remember, earnings are an accounting metric, but cash is reality. And right now, the real cash generation is actually going backwards.
Section 3. The debt and cash picture. To understand exactly where this cash flow drain is coming from, we've got to examine their balance sheet and their payout obligations.
Let's start with a positive for you income investors out there. FIS offers a very solid 4.13% dividend yield. And when we look at the safety of that yield, it actually appears well covered. The payout ratio is just 32.43% of earnings. More importantly, it only consumes about 49.5% of their free cash flow. So, despite the shrinking cash flow we literally just talked about, management is still generating enough raw cash to comfortably pay this dividend, essentially paying you while you wait for a full recovery.
However, the balance sheet tells a much more concerning story about leverage. The current debt-to-equity ratio has surged to 1.32. When you compare that to their 3-year average of just 0.86, we're looking at a leverage increase of over 52%. They are taking on significantly more debt relative to their equity, and that adds serious financial risk, especially in an environment where, as we saw, free cash flow is contracting.
And this leverage issue brings us to a potential liquidity pinch, perfectly represented by this number, 0.59. This is both their current ratio and their quick ratio. What does that actually mean? It simply means that for every dollar of short-term liabilities the company owes, they only have 59 cents of liquid, highly accessible assets on hand. As Benjamin Graham would tell you, anything below 1.0 suggests a company could face real friction if all its short-term debts were suddenly called in at once.
Section 4. Margins and profitability trends. Let's see how all of this builds into their actual profitability. Are they actually becoming more efficient at making money on the core services they provide?
Just look at this leap in operational efficiency. For the past 3 years, on average, their return on equity was a dismal negative 24.79. But today, they've yanked that ROE back into highly respectable territory, sitting at a positive 16.71. So management is finally generating real returns on the shareholders' capital.
We can pinpoint exactly where this turnaround is happening by looking at the margins. On the left, the gross profit margin is essentially unchanged, holding steady right around 36.7%. That tells us the direct costs of delivering their services haven't really changed, meaning they likely haven't gained any new pricing power or widened their economic moat. But the net profit margin, that has surged from a deeply negative 56% 3-year average to a positive 7.47% today. This absolutely proves the EPS explosion isn't some top-line pricing miracle, it's a story of aggressive internal cost-cutting, restructuring, and bottom-line optimization.
Section 5. Is the valuation justified? So we have a company with a severely punished stock price, shrinking free cash flow, but rapidly accelerating bottom-line profitability. Let's transition to the final piece of the puzzle. What is the stock actually worth today?
This table breaks down the current valuation. Right now, FIS is trading at a price-to-earnings ratio of just 8.27, compared to its own 3-year historical average PE of over 98. I mean, that is a nearly 92% discount. And you see the exact same story across the board. The price-to-sales ratio is nearly 45% cheaper than its historical norm, and their enterprise value relative to operating profit, that EV to EBIT metric, is discounted by nearly 19%. By almost every historical measure, the market is pricing this company like it's going out of business, completely ignoring the recent net income turnaround.
So, the absolutely crucial point here is understanding this concept, the margin of safety. This right here is the cornerstone of quantitative value investing. It's the numerical cushion that protects us investors from errors in our analysis, unforeseen corporate missteps, or just crazy market fluctuations. The goal is simple. You want to buy a stock when its market price is significantly below its true intrinsic fair value.
And when we run the raw discounted cash flow metrics for FIS, the numbers give us a very, very clear picture. The calculated fair value price for this stock is $69.55, but the current market price is languishing all the way down at $42.60. That gap provides a nearly 39% margin of safety. For potential investors, this means the market is currently priced in so much negativity that there is a massive numerical cushion if the company just manages to maintain its current operational trajectory.
Which leaves us with the ultimate question. We've seen the explosive 3,000% recent EPS growth and the deep 39% margin of safety. But we've also seen persistently shrinking owner earnings, likely structural accounting shifts, and surging debt leverage with pretty weak liquidity ratios. So, I leave you to consider the data we've unpacked today. Is FIS a classic misunderstood bargain waiting to reward the patient value investor, or is it a dangerous value trap hiding behind short-term accounting optimizations? Thanks for joining me on this explainer, and I'll catch you next time.